Welcome to Options 101, Terminology and Basic Concepts. This is Part 7, brought to you by TradeRightly.com. Now, the remaining slides and however many segments left in this video series are going to cover the concepts needed to understand how the value of an option contract is determined. That is, where those bid and ask prices that we saw in the options chain come from. This is going to set the stage for how we pick our strategy, what strategy to use, and why that strategy makes us money. Now, one of the coolest characteristics of an option is that they lose their value over time. And that may sound weird that I'm excited about assets that are constantly losing value, but you'll begin to understand why soon enough. An options value has two components. The first is intrinsic value, which is pretty straightforward. It is simply how much the option is in the money. This is the amount of profit that can be realized if the option were exercised right now.
The second component is the extrinsic value, which is a bit more complicated because it is determined by various factors, the two most important of which are time and volatility. Extrinsic value is what the seller gets above and beyond the exercise value for taking on the obligation risk. Remember, if the buyer exercises his option, the seller gets assigned and has to complete the transaction on the underlying. He's for damn sure going to want some incentive for taking on that risk. So extrinsic value is the market's assessment of the fair value of that risk. And I'm going to show you I'm going to go into the option chain in a minute and try and show you the math, on these two different components so that it becomes a little bit more intuitive for you. But one final note. Because intrinsic value, remember, intrinsic value is how much the option is in the money. That means that out of the money options, by definition, have no intrinsic value. Their premium is made up entirely of extrinsic factors. So let's take a look at the chain to see what this looks like or what this means. Let's look at the August 13. They have 7 days to expiration. So we're just looking at the 435 to the 475. If Apple's currently trading at 456, basically, the 455 is in the 455 call is in the money, and it's $1 in the money because Apple is trading at 456. The 455 call is $1 in the money. The 450 call is $6 in the money. You can see that it keeps going up. We just keep adding 5. This would be $11 in the money, $16 in the money, so on. And the same holds true for in the money puts. As we go up above the current price, those are in the money. Because remember, calls they give us the right to buy stock. So if I have the right to buy Apple at $450, the value of that option is at least the difference between what the option exercise strike price is and what the current price is. So if Apple is currently trading at 456 and I can buy Apple stock for $450 a share, I could immediately then sell it at a $6 profit. So the value of this option is at least the difference between those two numbers. Now, if I actually look at the bid and ask prices of that 450 call, you can see it's more than $6. $6 is the intrinsic value. Remember, we defined intrinsic as the amount in the money, and that's just the measure of dollars from this at the money point where the shading begins, which is at 456, where Apple's currently trading. To go from 456 to 450 is $6, so that is the amount of intrinsic value. $6 in the money. But that option is trading for more than $6. And so the portion above the $6, in this case, $2.75, that is the extrinsic value. That is the fair market assessment of what it costs the buyer, what they're going to have to pay the seller of that option to take on the risk that they are going to get assigned. So that's a quick introduction into where do these numbers, when we're looking at the chain, where do these bid and ask prices for both calls and puts, I can look at the bid and ask prices for the puts as well. Where do these numbers come from? It's not important that you know exactly how these are derived. If you're looking at these numbers, it's good to understand how they are determined, and to know that they're determined in part by what the exercise value is, and then there's a component that is related to the risk associated with those options, and that's how they're priced. Now remember, if I go back to my slide, remember we said out of the money options have no intrinsic value. That's because they're not in the money and they can't be exercised for a profit, right? If I own the 465 call, that gives me the right to buy Apple stock at 465. There's no profit in buying Apple at 465 right now because it's selling on the open market for 455. Why would I want to buy it at $10 a share more? So you can see here, there's no intrinsic value. This is not the difference between the $10 that it's where it's currently trading and to get this 465 strike price. This is entirely extrinsic factors. There is no exercise value to that option. We're going to talk more about value in the next episode, but that is the end of this episode of Options 101. For more information on how you can beat the pants off the market, visit TradeRightly.com.